So hello everyone and welcome to this another video presented by Bitcoin Hitpoint. By the time this video ends, I'll make sure that you know everything there is to know about yield farming and everything around it. So as the topic suggests, we'll try to understand everything about yield farming in the most basic terms. Also, we'll try to discover some effective strategies, understand the risk, and also make some smart choices in crypto farming. So let's just deep dive into this one. So first, let's try to understand what yield farming actually means. So a simple and a basic definition of yield farming is making your crypto work for you. And that is exactly what passive income means as well, right? So yes, yield farming is one of the best sources of passive income, and how I'll make you understand that in the future part of this video. So here what happens is that you maximize your crypto's potential instead of letting it sit idle in your exchange, in your wallet, or wherever. So give you a quick example. If you hold $10, let's say in your MetaMask wallet or in your BingX exchange, those $10 will always stay $10. No matter if it's a bull market, if it's a bear market, $10 will always be $10, right? The buying power goes high and up, and inflation and stuff like that, let's not consider that, but $10 will always be $10. But what happens in yield farming is when you use that $10 and invest it into a DeFi platform. Now what are those platforms? I'll make you understand about that as well. But then yeah, just those $10 which were of no use for you, if you invested somewhere, you can be making anywhere around 10, 12 or 15% on that particular investment. How do you do that? Obviously we'll be covering that as well. But then yeah, when you are yield farming, you are making some money out of it, which can be either in the face of some transaction fees, you can be making some interest, you can be making some bonus crypto rewards, and even more. Now how you do that, obviously we'll be covering that as well. But then yeah, crypto farming or yield farming basically is you yourself becoming a bank. You can be lending it to someone and make some interest against it, and different ways as well. So before understanding about yield farming, I would recommend let's try to understand about DeFi platforms first, because yield farming is done on DeFi platforms. So DeFi platforms are basically your support level, is what I would say, where all your transactions are done. So what is a DeFi platform? It's basically a bank, is what you can say. You deposit your funds there and they help you make money against it. As I said, it has some bank-like functions because those platforms will be lending, they'll be borrowing, they'll be letting it to someone to trade or become a middleman and make some money out of it. And second important point about these platforms are they are blockchain powered. So they are absolutely secured in their own ways, which gives them an edge. Now obviously there are certain risks against this as well, but we'll try to understand about them in some time. Now some of the most popular DeFi platforms according to me are Aave, Uniswap, Curve Finance, and even more. Now let's try to understand how yield farming works. So yield farming is nothing but providing liquidity to a DeFi platform. So I just explained you what DeFi platform is. Basically DeFi platform is a bank. Now yield farming is done in a bank. So let me give you a real life example. When you have $1,000 and you want to deposit into a bank, all you need to do is get to a bank, give them your money, and they'll make the deposit for you in your particular account. So that deposit that you did in real life is called as providing liquidity in DeFi platform. Even in real life, that is called as providing liquidity, because now that $10,000, your bank will be using it to giving it as a loan to someone. They'll probably will invest it somewhere and make money out of it, right? So that is what you call as providing liquidity. You are giving your money to a XYZ DeFi platform or a XYZ bank. But when you deposit your money into your bank will also give you a receipt against it, which will say that you have deposited $10,000. So similarly in DeFi platforms, when you give them with liquidity, when you provide them with liquidity, they will give you LP tokens against it. Now those tokens are a proof that you have deposited $10,000 in their DeFi platform. So that is what LP tokens mean. And once you have that receipt that you have deposited the money into your bank account, or you get LP tokens, it is a proof. So after that, every time when bank makes profit because of your money, they will be giving you a certain percentage which was pre-decided. So obviously those percentages are flexible. Sometime it might go higher, sometime it might go lower, but then usually it depends upon what kind of DeFi platform that you have invested in. So as you can see, the third point that here says earn rewards. So that is what it actually means. When your DeFi platform makes money because of your liquidity, they will be providing you with rewards against it. Now this rewards completely depend upon what was your liquidity size. what was your initial investment, and based upon that they will be providing you with rewards. Now in yield farming there is something called as liquidity pools and LP token. So let's try to understand them even better. What does liquidity pool mean? So again, a very basic example of this would be your bank accounts again, or your bank again. So what happens is that there is a XYZ bank, no matter if it's an international bank or if it's a national bank, they will have multiple branches in multiple states, right? So each state is providing liquidity to the main branch. So those state branches can be called as liquidity pools because everyone is providing their liquidity to different kind of pools. So one bigger platform has multiple liquidity pools. Now let's say state A is bringing in more liquidity, so they will be making more rewards against it as well. So now you need to know which liquidity pool is better, which is healthier, which has bigger value logged in into it, so that you want to invest in those kind of pools as well. In real life, obviously you cannot travel to a certain kind of branch or to a certain state just to deposit your money. But when you are yield farming, you can definitely do that. You can find out which are the best liquidity pools and only invest into them, right? So that is what liquidity pools mean. But now let's try to understand the process of what happens when you invest your money into a liquidity pool. As soon as you invest your money into a liquidity pool, the pool starts to use your money for trading purposes. Now the trading does not mean just buying or selling or going long and short. They can be using that money for different purposes, which are again, you already know about them. It will be mentioned in their white paper. They will be talking about it. The announcements will be made, like what is the use of your money in their programs, in their platforms. So let's say now they start to use your money to invest somewhere or to trade or to lend it to another crypto users. They will definitely be making money against it. And once they start to make money against it, they will be providing you with your cut as well. Whatever was your dedicated percentage, be it 10%, 8% or 12%. So against your initial investment, you will be making that kind of percentage as well. So that is what happens when you provide your liquidity into a liquidity pool. The trading is enabled. Now once the trading is enabled, you also receive your LP tokens. So now LP tokens are basically your receipt that you have invested your money into those liquidity pools. That is what LP tokens mean. LP tokens, the full form is liquidity pool, again liquidity provider, based upon whatever you want to consider. It has different full forms. But this liquidity provider tokens or liquidity pool tokens, they are not just a single coin. They are a mixture of two different coins. So let's say XYZ protocol works on Ethereum and Bitcoin pair. So your LP token will be called as Bitcoin Ethereum coin. Alright. So it is a mixture of 50% Bitcoin and 50% Ethereum. So let's say if the price of Bitcoin pumps 10%, your LP token value will also increase by 5% because the contribution of Bitcoin is just 50% only. Alright. And let's say the value of Ethereum dumps by 50% or 5%. Let's say it dumps by 10%. So your whole LP token value will only decrease by 5% because Ethereum is only contributing 50% to that token. Alright. It's a bit confusing, but do not worry. I'll be covering all of that in the future videos as well. If you guys have any questions, if you have any doubt, make sure to drop them in the comments so that I can read them and answer them right there. Alright. Also, you can let me know if there are any certain topic that you would want me to cover on this channel. I'll be more than happy to do that. Now, once you have received those LP tokens, the procedure from your end is done. Now everything is based upon whatever your DeFi platform is doing, whatever the procedure is. You will always know how much time it is going to take. And once you have done everything from your end, all you need to do is keep on claiming your profits. So these profits can be received on daily basis, on every 15 days. It is again, it's all pre-decided. You will always know what is the time period after which you will be receiving your profits. And you have two options. Either you can claim those profits or you can just compound them. So let's say if your initial investment was $100 and you made $5 against it. Now you have two options, either withdraw those $5 or just invest those $5 again into your $100. So now instead of receiving 10% against your $100, you will be making 10% against $105. So compounding obviously has its own effect. It has its own advantage, but it can also be a bit dangerous. why, I'll help you understand that as well. Now we've understood how yield farming actually works. Let's try to understand what are the various ways through which you are making money in yield farming. So your DeFi platform can be into any kind of transaction. They can either be into trading, into investing, into any XYZ kind of activity. But mostly when you are making money in yield farming, it is out of these three ways. The first is trading fees. So again, a very basic example of this would be, let's say if you're trading on BingX or on Binance or on Bybit, even if you buy, sell, if you go long or if you go short, no matter if you're making money or if you're losing money, you are always paying a certain percentage as trading fees. So that trading fees can be anywhere around 0.02% or 0.03% of whatever your whole transaction was, right? So now, again, as I said, no matter if you're making money or if you're losing money, your exchange is always making money. So if you invested in such kind of DeFi platform, because trading can be done on DeFi platforms as well. So every time someone is buying or selling on the platform that you have invested in, you will be making a certain cut out of that trading fees. So let's say if your exchange made $1,000 in a day, so out of that you will be receiving 12% against whatever your investment was. All right, so that is how you make money in a way from yield farming. Second would be bonus token rewards. Now what is bonus token rewards? So let's say if I had my own DeFi platform and you invested into it for yield farming, and if I'm trying to expand or if I'm trying to bring in a new feature or if I'm going to make an airdrop, I'll be issuing some bonus tokens as well. Now those tokens will not be available for everyone, but it will be only for the people who are investing into my platforms. So it is one of the another ways how you will be making money in yield farming. And third is the basic one, compounding. Now compounding can be extremely risky because you always do not have a plan like how long are you going to compound your money. So let's say you are making $10 on daily basis and you plan to keep on compounding. After a duration of let's say 10 days, your $100 investment is now $200. So you are making 10% on your $200, not just $100. But if you do not have a clean and clear direction, like for how long are you going to do this, you will keep on compounding, and probably after a certain period of time, that DeFi platform would just disappear, or they might rug pull, or they might face a bad news which just jumps their token values. So you always need to have a plan with compounding. Let's say you can compound for a day and then not for 2 days. Just claim your rewards for 2 days, and every third day you can be compounding your rewards. So that way you are making some money and also increasing the value of your initial investment. So that is something important as well in yield farming. Next, there is something called as impermanent loss. Now I'm sure you guys must be knowing about it, but if you don't, let me give you another basic example about this. Let's say you bought Bitcoin worth $10. So now the holding of your Bitcoin is $10. Let's say the value pumped by 10%. All right. So your $10 worth of Bitcoin is now $11 because the value of Bitcoin has went up by 10%. But if it just jumps by 10%, your $10 are now $9. So if you do not sell it, you are in a loss of $1. Even though if you are not selling it, you are still in loss. So by the time you do not sell it and you are in loss, that period is called as period of impermanent loss. So if you do not sell it, you are into impermanent loss, but if you sell it, you have realized it. So you are no more into an impermanent loss, but you have realized it. So that's the difference between impermanent loss and realized loss. So impermanent loss can be another factor which will decrease the value of your investment into a DeFi platform, because again, crypto is extremely volatile. So you do not want to be using exchanges or tokens which are extremely volatile and they keep on pumping and dumping on a bigger percentage basis. So if I help you understand here with the flowchart that we have made. So first, if you made an initial deposit of let's say again $100, and then the price changes. So you invested $100 into an XYZ DeFi platform, and now the value of that token has dumped by 50%. So your initial investment, instead of being $100, is now just $50, and that is an impermanent loss. If you plan to sell it now, if you just sell it, you have realized that loss, and it's no more an impermanent loss, but it's an realized loss. So impermanent loss can be another factor which can impact your yield farming journey. So you always want to be using tokens which are not extremely volatile. Third thing is pool rebalances. So whatever pool that you are into, if they are facing high inflation, if they are facing any kind of issues, they might consider selling that particular token, which will again lead to price going lower again. Now let's try to understand some of the ways using which we can reduce this impermanent loss. So first one is using stable coins. So stable coins are the only coins whose value will never pump or dump. $1 is always going to be $1, right? So the only downside of using these coins is that when the risk is low, the rewards are low as well. So you might not be making some extremely high numbers of returns if you are yield farming using stable coins. But then as a beginner, it would be a smart decision to use stable coins only, because you do not want to make bigger loss right in your first attempt. Second is similar assets. So you can be using Ethereum or Bitcoin against a wrapped Bitcoin, like you can see here, right? Like Ethereum and WETH. That W stands for wrapped Ethereum. Now what does that mean? So when you are using Ethereum on Ethereum's own network, it is called as Ethereum, but then you can be using Ethereum, you can buy it on AVEX, you can buy it on Matic, you can buy it on different coins, different networks, right? So you won't be buying Ethereum exactly, it would be wrapped Ethereum. And once you plan to bring it on Ethereum chain, it will just burn that wrapped Ethereum and it will give you the original Ethereum on Ethereum's own chain. It's a bit complicated. I'll try to explain you those in the live stream that we do on daily basis, so that such stuff I can explain even better when I'm on the live stream with some live examples as well, with some datas and everything that I can show you there. So make sure you subscribe to this channel and like this video as well. If you have watched the video till here, I'm sure it's being entertaining for you as well, something which is providing you with information and knowledge. And look in the description, I'm sure you will find some valuable links as well. All right. Third point is single-sided option. So as I was telling you initially, that LP tokens, which is liquidity provider tokens, are usually a combination of two different coins. So it can be either Bitcoin, Ethereum, Bitcoin, USDT, or whatever coin that DeFi platform supports. So then there is also an option that you use a single-sided coin. So you can just use Ethereum, or you can just use Bitcoin for yield farming. So your complete move of the price or of your profit will depend upon how Bitcoin is moving. And let's say if you believe in Bitcoin for the future and you think it's going to go only higher, you can be using Bitcoin so that it keeps you bit safe against any other kind of assets or any other kind of coins. Monitor markets. Now you need to keep an eye on the pool that you have invested into. You need to check if it's still healthy or not. Now what do we mean by if it's still healthy or not? This actually means that if new money is entering into your pool, or people are trying to exit, if the bigger players are trying to make an exit, that is the sign that something is not good and you should plan an exit as well. Next, according to me, is a very important point, which is APY versus APR. Now this is the term in which you are getting paid. So APY, which stands for annual percentage yield, and APR, which again stands for annual percentage rate. Now there is a slight difference in between these two, which according to me is very important for you guys to understand. So let's say if your DeFi platform is providing you with a 10% APR, so you will be making 10% at the year end. All right. So let's say if you invested $100, you'll be making $110. But that's not the case if you are getting paid in APY, which is annual percentage yield. Because in annual percentage yield, you will be making more than 10%, because here they have not counted your compounding percentage as well. So for 12 months, there will be a certain percentage which will be compounded as well. And that's why APY is different than APR. Now you need to know what are you most comfortable with, what kind of APR or APY, so that when you are doing your research before investing into any DeFi platforms, you already know what are you expecting. Next, let's try to understand a very important part, which is risk in yield farming. Now there are not a lot of risk, but whatever are there, they are more than enough according to me. The first one is volatility risk, which is very obvious. Crypto and volatility, they go hand in hand. Like crypto is basically known for volatility, right? So if you invested again $100 and there is a volatility of 50% against you, so even though you are making 12%, 13% or 40% on whatever investment you made, you still are making a loss because the value of your coins have now went down. Second is something which is not in your control, which is smart contract risk. Now, when a DeFi platform is made, it's completely on the basis of Web3. Basically, it's all about coding, right? So if there was a bug in coding and if a hacker spots it, it's very easier for them to just basically hack all the money that is into a certain pool or like in every pool and then just vanish away with it. So you cannot do anything about it because not everyone is a coder and they can spot some bugs. But yeah, that is something which is a very big risk in yield farming. Third is impermanent loss. I'm sure you guys already know what that means. And fourth is rug pulls. Now rug pull is something which is extremely fashionable in crypto. What does that mean? Let's say I made my own DeFi platform where you guys started to invest into, and after a week or so I decided that I've got more than enough money into the pools and I can just run away with it. And that is what I do. It's that simple. I can just run away with all your money which is into my DeFi platform. So it's very important to only invest into those platforms which are extremely secured and have been in the space for a very long time. So how do you identify which of these DeFi platforms are safe and secure? There are certain criteria that you can consider before investing into a DeFi platform. First is that each of these DeFi platform that you are investing into should have more than 1 million as their TVL. Now what does TVL means? It means total value logged. So if there is a bank which has, let's say, 100 CR and then there is a bank which has 10 CR, no matter 10 CR is a big amount or not, but you will always believe in a bank which has 100 CR against a bank which has 10 CR. So that is what you want to do. You want to be investing into platforms which has higher value inside them, which is again total value logged. Second is multiple audits. Now what does audit means? I'm sure in simple terms you guys know what audit means, but in DeFi platform there are always a third party platform which can be auditing this platform. So there can be different firms who can audit the codes, audit the bugs and everything, and then they can give you a report that if that platform which you are planning to invest into is secure or not. So if they are ready to do that, like if they can get it done from a third party which are not their in-house auditors, if they can do that, let's say from 2+ and more, it's a great sign that you can be looking to invest into those kind of projects because they are being transparent, and you can consider into investing into those platforms. Next, and again a very important one, is investing into platforms which have realistic APY. Now there can be platforms which will give you a 10% return on daily basis or 20% return on daily basis, right? So people would be much more interested into investing into those kind of platforms because they are giving you 20-30% return on daily basis. But that is absolutely not sustainable. No platform can keep on doing that for a very long time until unless they have a very unique idea which is sustainable. They cannot keep on doing that. So mostly exchanges or DeFi platforms, they do this so that they can attract a lot of new customers to that platform and they eventually will reduce it. Or if they are scammers, they'll keep on doing it for some time and then just rug pull is what, as I mentioned earlier, they will rug pull their project. And the next part is having 100% team transparency. Now a very unique point about companies in crypto is that they have a choice to not show their face or do not dox them, is a term used in crypto of not doxing them. What does that mean? Not providing the document. So whatever is their ID cards or whatever is their nationalities, let's say if you are into US, if you are in India, if you are in any XYZ country, you have a certain kind of documentation that you need to do before starting a firm. But if you are into crypto space, you do not necessarily need to do that. But if companies still go ahead and do it, that shows that they are being transparent and you can definitely trust them. So always trust a firm which has transparency rather than trusting into platforms which are trying to keep themselves secured and not trying to dox themselves. Now let's try to understand what are the different types of yield farming strategies. So the very first one is extremely low risk farming. So here you will be using pairs like USDT and USDC as a single LP token, and you will stake them or use them for yield farming, and then you will be making some returns against it. And as I said, because the risk here is extremely low, so the rewards will be low as well. Second is medium risk farming. Now here you are using a single volatile asset with a stable asset. So here you are using, let's say, Ethereum with USDC or Ethereum with USDT of Bitcoin with USDT. So one of the token is flexible and one token is stable. So that is called as medium risk farming. Third is extremely high risk farming. Here you are investing into new tokens or meme coins, because here you receive extremely high risk, so you are getting high rewards as well. But such kind of pools or such kind of DeFi platforms are not very sustainable, so you'll always have to be cautious when you are investing into them. A quick tip from my side would be start with safer strategies before experimenting with riskier options. So going with low risk farming or max to max with a medium risk farming is what is recommended. Do not go for high risk farming because they are not very sustainable and they won't be providing you with returns for a very long time. Also, if you are interested to start yield farming, here is a quick guide which will help you to get started. The steps might change a little bit based upon what platform you are investing into, but this is a basic one and this works with almost 99% of the exchanges or 99% of the DeFi platforms. So the very first and the most important step is creating a wallet. Now you can create a wallet using MetaMask, Trust Wallet, or any XYZ wallet which is compatible with your DeFi protocol. I would say MetaMask is a higher and more secured one, but then again, it's your choice. You can do your own research. Second is adding funds to your wallet. So you can either buy some USDC, USDT, or whatever token that you need using your wallet, or you can just add it from a different exchange. Let's say if you are using a BingX account, you can buy funds on your BingX and then just transfer it to MetaMask. Also, if you guys are interested into signing up to a crypto account, you can use the link in the description, which is of BingX. That is our highly recommended exchange. We are using that for a very long time. If you use that link, you stand a chance to win up to $6,000 as bonus. And also if you use that, you will also be added into our very premium group where we share some of the most trading opportunities and even more insights as well. So make sure you use that link and stand a chance to win up to $6,000 at least. Next is you have to connect your wallet to a DeFi platform. So once you have added funds to your wallet, you can use that wallet to connect with your DeFi platform. So if you are going to be using Aave, Uniswap, or any other protocol, let's say if you are using Uniswap, just go to the website of Uniswap. On the very top right side, you will be seeing an option to connect the wallet with Uniswap. So just click on that and your wallet will be connected. You will also need to make a password of your MetaMask wallet, but that is again a personal thing. Set up the password, and once you try to connect your wallet with your DeFi platform, you will need to enter that password and you will be connected with your wallet and your DeFi platform. Fourth is pick your farm based on rank and reward preferences. Now farm based means the protocol or the pool that you are planning to invest into. So every DeFi protocol have different kind of pools or farms in which you can yield farm, right? So now it is divided into different categories, which can be, let's say, risk to reward wise. The higher the risk, the higher the reward. The low risk one, medium risk one. So they divide different pools into different segments. So now you can select one of them and you can get started with them. So all you need to do is pick the farm that you are interested into, and then as the step number 5 says, deposit your tokens, and that's it. That's all you have to do from your end. Once you have deposited the tokens, then after the given period of time, you will be making whatever returns was promised to you. And in the end, it is highly recommended that you do need to keep on monitoring the performance and also consider compounding or reinvesting into your pool if it's performing well. Simple, right? These steps get your crypto working for you. Now here are some of the common mistakes that you as a beginner might make when you are going for yield farming. So here are some of the common mistakes that you as a beginner might make when you are yield farming. The very first one is going to be chasing the high APYs. So let's be very honest. Our very first preference when we start to do yield farming would be the pools that are providing the highest APYs. But that is the issue. Higher APYs are not very sustainable. They will eventually either go lower or they will just take away your money. So it's better to go for a realistic APYs, which is anywhere around 8 to 12% max, not higher than that. Yeah, if it's a great pool, if it has high security and if you can trust it, then definitely do consider them. But then yeah, anywhere below 12% I think is a great pool. Next is ignoring impermanent loss. Even though realizing your loss will be the final step and there is no way that you will be recovering the losses that you have made, but holding your impermanent loss for a very long time is also not a solution. So let's say if you could have exited with negative $10 PNL, holding your position for a very long time, it might result into a negative 50, negative 60, or probably make your $100 investment into a $0. So it does not make sense to hold your impermanent loss for a very long time until unless you have a very strong reason to hold it. Third is using shady platforms. Now there are new platforms which are being made on daily basis. So that's the reason why I mentioned that only use platforms which has been around for a very long time and whose team can be trusted as well. Next is forgetting gas fee. Now gas fee is something which is very important that you always need to consider. If you do not know what gas fee means, gas fee is basically the transaction charges. So you have to pay gas fee every time you buy something, every time you sell something. If you are compounding, if you are doing any kind of transaction on blockchain, every transaction will need certain amount of gas fee. So the gas fee on Ethereum chain is the highest. So just for buying or selling, at times you might be paying $100, $200 or $300 just as gas fee on its peak time. So you always need to consider, if you have low capital, always go for chains which have lower gas fee. And next is farming without exit plan. As I mentioned earlier, when you keep on compounding with an expectation that if your capital increases, your daily returns will increase as well. That is actually true. But if you keep on doing that for a long time, and let's say if your DeFi platform vanishes, if it rug pulls, or if they face any kind of bad news and the value just jumps, those gains that you made for last 30, 40, 50 days are just gone. So you need to be farming with the exit plan as well. You need to know for how long are you going to compound, for how long are you going to hold, and when you are going to exit. That's a very important part as well. Okay guys, so that was it for this particular video. I'm sure you guys enjoyed it. Obviously you did because you have been around for the complete video. I'm sure it was a pretty long one. But yeah, make sure you do subscribe to this channel, and I do hope this guide has improved your understanding of DeFi network. It's very important to stay curious, but it's also important that you do your research yourself. Also make sure to check the description to join our community, where I keep on sharing some great insights, some great updates about trading, about investing and whatnot, and be a part of that community. Share your knowledge, and you might get a chance to win some key position or role in our community as well. So keep learning and keep earning. That is what we would want to see for you guys as well, and I'll see you in the next video.